Welcome to another episode of Good Value by Antipodes.
Welcome to our final episode for 2023. It's Alison Savas, Investment Director at Antipodes. Global equities have had a strong year, with the MSCI ACWI up over 15% in US dollar terms as we record, which may seem at odds with the tightest monetary backdrop in over 20 years and fears over when the recession in the West would hit. But as we all know, headline returns mask that 7 of the largest stocks in the world, dubbed the Magnificent Seven, have accounted for a very large proportion of the gains. As we look toward 2024, the questions being asked by market participants are whether the Fed can achieve the perfect landing, when the central banks will start cutting rates, and will such narrow performance in the market persist. In the final episode, I'm joined by all Antipodes Sector Portfolio Managers. So for the next 30 minutes or so, they will share their thoughts on their specific areas of expertise as we head into a new year. I'm going to ask each portfolio manager for one stock or area of their coverage that they believe will perform in the year ahead, and one stock or part of the market that they believe investors should avoid. So let's get into it. First up, we have Graham Hay, Antipodes Portfolio Manager of Hardware, Industrials and Commodities. So, Graham, as you know, the first question I'm asking each Antipodes portfolio manager is, what is one stock or area of your coverage that you believe will perform well in the year ahead?
Hi, Alison. Well, look, just reflecting on the year that's been 2023 and looking at some of the innovations that are coming through, particularly around artificial intelligence and the infrastructure that is required to support these new technology platforms. There's one company in our portfolio that really stands out as a key enabler of that, and it's a stock that hasn't necessarily participated in the excitement, and that company is TSMC. It's the world's largest foundry. They provide leading edge wafer services to everyone from Apple, Nvidia, Qualcomm, and others. And they've been doing that since 1987 when they started the business. They have a very dominant share of leading edge capacity, and this is the type of capacity that's required for, the iPhone 15, for the generative AI applications that everyone is talking about. So these guys are critical in standing up all of the AI workloads that are being currently developed. And the shares trade today at a record discount to the broad semiconductor peer group. And so we think, as we look into 2024 and beyond, frankly, this is a company that should, participate enormously in that cycle of innovation, just like they did in the smartphone cycle from 2010 onwards. They've made all the requisite investments, and I think they're now leveraged, or they're positioned to harvest that investment for growth and profitability.
It's pretty interesting, isn't it, that you've got a critical enabler of such an interesting long-term trend available at a record discount. Now, can you share a stock or part of the market that you believe investors should avoid?
Sure. Well, I think probably on the same vein, there's probably words of caution around AI as well. A lot of excitement around the what's being enabled by these new platforms. I'd just be careful that I suppose there's an element of one-time investment that's going on today. And there is literally an arms race between all the large cloud companies to get capacity ready for customers. When you go and speak to corporates, there's a lot of watching and understanding, but not a lot of investment going on. So, I think you just need to be a little bit cautious around the extent of one-time upfront investment or pull-forward investment that may normalize to lower levels, later in 24 or into 25. So companies that are priced for that to be sustainable run rate business, I'd be a little bit cautious on, because I think we could get a reset to a lower level of investment as the year progresses in 2024.
And Graham, before you go, and I introduce our next team member, a little end of year fun. If you could ask one person, dead or alive, to Christmas lunch, who would it be?
Okay, well, that's an interesting one. Well, I'd say, and I say this because I've recently been reading his books and his work It's probably not someone that many people would know. It's an author. His name is John D. MacDonald. He was a very prolific author during the sort of 60s and 70s, I guess, were his heyday. And he's probably best known for a series of books he wrote around a character called Travis McGee, who was a former army guy turned sort of private detective. And he weaves the stories of this individual through the sort of the 60s and 70s era of Florida. And he just brings to life so many different human elements, but he weaves into it a lot of interesting business and government related sort of matters that were happening at the time, and the books are tremendously enjoyable to read. I'd love to have Christmas lunch with that particular author just to understand how he put it all together, and pick his brain on a range of topics that he covered in his books.
I love that. And I'm really looking forward to seeing who we accumulate at our Christmas lunch table as this podcast progresses. Thanks, Graham.
Thanks, Alison.
My next guest is Nick Cameron, portfolio manager who covers healthcare. It's been a while since we've had you on the podcast, Nick, so really nice to speak to you again. First question, one stock or area of your coverage that you believe will perform in the year ahead?
Well, I think there's two answers I can give to that, because firstly, we think the medical device companies are set to have a pretty good 2024, but in particular, we think those names that are in the small to mid cap part of the market, particularly some of those that have suffered, from the GLP-1 and the obesity drug hype, we think are set to have a pretty good year of outperformance. And the reason for that is multiple fold. One, we think the GLP-1 debate, whilst not going away, results from these companies should continue to be pretty resilient, as a lot of them have good structural secular growth drivers, including the aging demographic, which isn't going away. And so putting that together, we think some of those names are quite interesting. And also in light of the recent Fed moves to, I guess, soften their position on how long rates will remain higher for longer, it's seeming like, that we are getting closer to the out of the woods scenario, which is, we think, going to reignite M&A in the sector, and particularly those larger medical device companies are the ones where M&A is part of the business model, and they need to continue to acquire these newer, brighter young companies to continue to deliver organic growth. And so the second part of the answer is one of the stocks that we like is Alcon. It's had some recent setbacks around growth in the last quarter, was a little bit tough after some pretty, let's call it a string of results that have been very strong in its cataract surgery and intraocular lens business. And we think also some of the recent market commentary that, suggests that growth may continue to be slower for a little while longer, we think is probably overdone at this point. And we think with margins recovering after years of high cost inflation, which should see COGS reduce and that higher cost inventory get worked through the system over the next quarter or two, we see a really strong margin inflection story happening through 2024 for Alcon. And also we see, bolt-on acquisitions, particularly in the eye space, whether it's in the drug side or on the device side or equipment side. We think that sets them up for a pretty strong growth outlook for the rest of the decade.
And what's your stock or part of the market that you believe investors should avoid?
We think investors should avoid the US managed care companies. We think they're at significant risk of underperforming in 2024. They've had a very strong period of performance over the last 6 months. And these are the big health insurers in the US, names such as United Health, Cigna, Humana, CVS, and Elevance. These businesses, particularly for most of them, a lot of the growth in the US health insurance market over the last 5 to 10 years has really been driven by increasing adoption of what is called Medicare Advantage plans. These are plans that US seniors who become eligible for Medicare in the US, that's over age 65 and over, these Medicare Advantage plans are being administered by these commercial companies on behalf of the US government, and a lot of share has been taken away from the traditional Medicare or government-run insurance into these managed care company-run or Medicare Advantage plans. Now, one of our concerns has been for many years is that these companies have been effectively gouging or profiteering from these government or what is essentially government-funded plans. And the US government has become far more aware of some of these issues. And we think this increasing scrutiny, is going to see action being taken. And we have seen some legislation pass the House recently in the US. And we think there's just going to be continued scrutiny on these commercial insurers delivering Medicare Advantage plans. So we think that the growth in those businesses, whether it's from the top line or in terms of profitability, is going to become more clouded going forward than it has been for the last 5 years. And it's also important to remember that many of these companies have large pharmaceutical benefit businesses where they manage drug insurance plans for US employers, for individuals. And these businesses have also come under a lot of regulatory scrutiny recently. And we think the risk of legislative or regulatory change to increase pricing transparency, profitability transparency in these PBMs is going to increase in medium term, and again, crimp growth in that part of the business. So we see limited upside really in a lot of these names going forward, and being a highly consolidated market, there's very little opportunity for M&A, at least at the larger end of town, and options they do have are quite incremental and small compared to the very large revenue base and earnings base that these businesses are operating from now.
Okay, last question. One guest, dead or alive, for Christmas lunch?
Ooh, it was tough. It's a tough one to go with, but I think I have to go with Tiger Woods. And the reason being is, one, I'm a golf fan, but number two is just, I don't think I've ever seen a sportsman quite like Tiger and how well he was able to perform under pressure. Now, someone else who might be on this podcast, I think probably has the other one who I think is very much like that. But Tiger was just so consistent under pressure. His ability to make clutch putts, to make the tough shots under pressure when all was on the line, I haven't seen anyone really do that. And so I think, that aspect has a lot of parallels, I think, with investing. There can quite often be a lot of pressure, a lot of noise, whether it's crowds, and you can really, I think I could really learn a lot from him of, some of the techniques he used whilst he was under those pressure points, how he was able to focus and visualize what to do, and then most importantly, execute on that. I think that would be really useful to hear what he would have to say about that. Now, the other aspect, I think, which would be great to rack his brains about, is adversity and coming back from adversity. He had suffered a lot of injuries. He still won while actually being quite injured and very hurt in his knee. And also in his personal life, he had some, pretty clear personal dramas that occurred in his career, but he's gotten over or seems to have gotten past a lot of those and is back and is still competitive. Now, whether he can still compete at the level to win more majors, I don't know. I hope so. But I think he's still able to mix it with the best, and over such a long career and having been so dominant, I think, that's what I'd like to have as an investment career, having a long career, and you will face adversity, and to, I guess, really just get tougher and stronger as you go.
You're right. That mental resilience really is something which applies. I mean, he had outstanding mental resilience, but it is certainly something that applies to our day-to-day. Thanks, Nick.
No problem. Thank you.
Now it's time to turn to Max Shramchenko, Portfolio Manager of Infrastructure and also Antipodes Climate Delta Fund. Again, Max, it's been a while since you've been on the podcast, so great to have you with us.
Yeah, hi, Alison. Thanks for having me.
So, what's your stock or area of coverage that you believe will perform in the year ahead?
Look, you can call me boring, but I'm gonna bring out the regulated utilities in the US. I think the sector is pretty interesting. You know, it's been through a pretty brutal derating over the past couple of months. You have the sector trading at about 20% discount to S&P on the PE basis, for what I consider a pretty defensive and reliable earnings power and a nice structural growth story. So, you know, in the past, you've maybe had, I don't know, over the last 20 years, you've had maybe 3 or 4 occasions when the sector was as cheap as it is now. You know, it would have been .com, it would have been GFC or COVID. Clearly, you know, the high interest rates and the fears of inflation feeding through the expense line for these companies has been a fear for the investors. And you know, the way we look at it is if you're prepared to take a relatively longer horizon here, you know, if you're looking out 3 years or something like that, the good thing about these utilities is their regulatory construct allows you to offset virtually all of that in, you know, inflation in your labor or be it high interest cost. So as long as you're prepared to, you know, have a longer term view, I think it's a very interesting time right now to be looking at these. And, you know, specifically for the stock that I wanted to bring up for today, you know, the American Electric Power, it's one of the larger, I guess, more liquid names in the space, and it manages to trade at about 1 turn of a discount on the PE basis, further to the already cheap sector. And the reason why it does that is primarily because of a few regulatory mishaps that they've had over the past, call it 12 to 18 months. And the market is just taking that and extrapolating that into perpetuity, which, you know, whenever the market does that, I kind of feel very good about it. You know, low expectations are a friend of good, you know, future returns. So that's my stock.
And I would add as well, Max, AEP is one that, you know, another sort of multiple way of winning from it is it has a large percentage of its assets in high voltage transmission, which is going to be a big beneficiary of the energy transition, won't it?
Yeah, absolutely. And you know, if you're buying that earnings power today at, you know, 15 times earnings or whatever it is, 14 times, you can count on a pretty decent structural growth that is going to come exactly from that part as you know, as America goes through not only a large replacement cycle that, you know, all this old transmission infrastructure needs to go through, but plus, as you mentioned, integrating all the renewables. Is going to take a lot of growth in capex, and that is what drives the EPS of these companies.
And what should investors avoid?
Oh, look, I've been sort of thinking about what's boiling under the surface in the real estate sector globally, and especially if you think about a couple of hotspots like areas where people have borrowed a lot. For example, you know, the CMBS market in US or some of the Nordic markets in Europe, for example, Sweden. There are companies out there, well, actually a whole sort of sector out there with leverage of anywhere from 10 to maybe low teens net debt to EBITDA levels, which is arguably pretty high if your cost of debt is in a high single digits. And there is a question there around the sustainability. And if you, for example, look at CMBS market, sort of over 2023, we've had roughly every second CMBS loan that was hitting the final maturity has actually not been able to refinance, so they've hit the defaults. That doesn't necessarily mean a fire sale and a collapse of the market, don't get me wrong, but the way I call it is like the snake has sort of taken the rabbit out and the rabbit is making his way through the snake. And it's a lengthy process. These markets were quite often designed to be protected from short-term volatility. But if we're having a discussion here about, a permanent reset in cost of capital by 300, 400 basis points, and that is here to stay, then definitely there is a lingering risk out there, a tail risk. in places like, as I said, CMBS in the US, or markets with a lot of leverage in Europe, which don't really have good maturity profile, like Sweden. So that's something that I'm sort of worried about. But obviously, given what's happened recently with, the Fed, and everyone's kind of really betting on the interest rates falling, I think we might be able to get out of jail. So it's all about how long the rates stay high, and versus us observing more and more of these defaults, and people unable to refinance their loans. So that's something that sort of really definitely keeps me up at night, and keep thinking about our exposures in that, through that, either through the financials or the direct property.
And finally, the guest of honor at your Christmas lunch.
Oh yeah, that's a cool one. I'm gonna be cool here. I'm gonna say Tom Cruise. I just always felt like, look, if there's something out there that the guy has for lunch that gets him on a bike and off a cliff at 61, I have to know what it is. And obviously, by the way, I'm a big fan, of his passion, and of all the efforts that he puts into filmmaking. I think it's quite extraordinary. So I think that's my Christmas lunch plan.
Perfect. Thanks, Max.
Thanks, Alison.
Okay, we're going to change tack and move on to the domestic parts of the market with James Rodda, Portfolio Manager of Developed Markets and the Global SMIDS Strategy. James, just as with Graham, Nick and Max, your first question is, what is the one stock or area of your coverage that you believe will perform in the year ahead?
Yeah, look, my pitch would be Oracle. I think it's the last mispriced, underappreciated cloud migration story. 4 points. The first one would be that their Oracle Cloud Infrastructure product has emerged as the fourth major public cloud alongside Amazon, Microsoft, and Google. It's playing a meaningful role in the AI stack, given the architectural advantages. And so a lot of the major LLMs are using Oracle, and we think it grows 50% plus for several years. On the SaaS transition side of the cloud migration, they're ahead of all their back office peers, complemented by a recent Cerner acquisition, which will have the effect of making them the default infrastructure provider alongside the application, because that runs hospitals and doctors and dental clinics, a bit like, say, office users tend to use Azure because they run their business on Microsoft 365. We think database migration to the cloud is also in the first innings. To give you an extent of the size of that opportunity, 15% of Amazon and Microsoft Azure revenue is databases. So as they migrate their databases to the cloud, there's an opportunity for a 6-7-fold uplift in revenue for those customers that migrate. Lastly, they've got a great capital allocation track record in terms of share buybacks, opportunistic share buybacks, and well-timed acquisitions. It's 18 times this year's earnings, not next year's earnings. And I think it's going to grow 10 to 15% through the course of the decade. If I had to throw one extra in on the small and mid-cap side, it would be Score, which is a reinsurer. The industry is going through a fantastically hard pricing cycle at the moment on the back of a lot of natural disasters over the last 5 years. They didn't reprice for those natural disasters. Now the industry is repricing for those natural disasters, and putting that into the model, we think it's around 5 times earnings. Putting the same assumptions into the model, most of the other, let's call it top 5 reinsurers around the world are trading closer to 10 times earnings.
And what should investors avoid?
There's a few things you can talk about. The 10 years move from 5 to 4, and maybe the upside is 3.5 this year, but it can move back to 5. But if I had to pick one thing, it would just be large caps. So I'll give you some numbers on this. The MSCI All Country World Index is up just under 20%. This is US dollar returns for the S&P 500 is 25. The top 50 stocks are 37%. So nearly 20% outperformance. So it's not just the mega cap tech that people are crowding into. There's very large companies, these top 50, that aren't mega cap tech. And be it index concentration or other factors, everyone's crowding into these names. If I just complement that, the Russell 2000 sort of small caps in the US is only up 12% compared to the top 50 up 37%. And Europe's been up 18%, China down 14% for the year. So, it's very unusual to see 2 years in a row of exceptional returns from the same part of the market. So I'd be staying away from large companies broadly. I think our funds certainly have an overweight away from that mega and large cap space towards more exciting, let's call it mid-cap opportunities, which in the global space might mean a company that's still 30 billion or 50 billion. Very large businesses.
Yeah.
But yeah, it's just those extremely large ones. There's been a lot of crowding.
I mean, it's really interesting, isn't it? Because we're all aware of that mega cap tech's done really well, but it's an interesting point you make that big caps broadly have done really well, not just the 7 stocks that we often talk about. Now, finally, who has a seat at your Christmas lunch?
My Christmas lunch, Michael Jordan. I'm a child that grew up in the 90s in the basketball era, played a lot of basketball. I think I have around 60 Michael Jordan cards. I had a close friend who loved David Robinson, so I was able to swap a Michael Jordan for a David Robinson, which is a great deal. And I just think, look, I love tennis, and there's the big three there, but it's really hard to identify who's the greatest of all time. And I think basketball's, stands alone, maybe with badminton and cricket, as one of those sports where you can identify very clearly the greatest of all time, and there's not much debate. So, Michael Jordan.
Perfect answer. Thank you, James.
Thanks, Alison.
Okay, last but not least, it's time for John Stavliotis, our Emerging Markets Portfolio Manager. John, let's hear one stock or area of your coverage that you think will perform well next year.
Yes, so in the year ahead, as we move into rate cut cycle, and it's increasingly looking like the world is going to avoid a catastrophic hard landing, I think it'll be generally positive for EM. And then within that, Brazil is somewhere where rates are already falling. Just this morning, while the market was really excited about the dovish tone in Powell's FOMC post-meeting discussion, Brazil's central bank was actually cutting rates by 50 basis points for the 4th time in as many months, and it's guiding to more into next year. Then you see the economy is actually showing signs of recovery. We've seen strong GDP growth, consumption recovering slowly as well. So a stock that we think will do well in this scenario is Sendas Distribuidora, which is the leading cash and carry grocery retailer under the brand Asai. So cash and carry is Brazil's take on discount grocery retailing, and it's the category that's growing fastest and is now about 20% of total grocery sales. So this stock faced a number of headwinds over the last couple of years. It's basically seen cost wage inflation being quite high, but at the same time, food inflation went negative after the high base of 2022 when food supply was hit by droughts. And just before this difficult period, they made an acquisition of supermarkets off their parents, and that was done with debt, whilst interest rates went from 2% to 13.75% over the next year. So you can see that over that period, earnings came under pressure, and so did the valuation. Things are really turning now. So cost inflation in Brazil is declining. Brazil's CPI at the last print was below Australia at 4.8%. Food inflation is improving. And the supermarkets they bought, they've been converted to cash and carry centres now, and sales per store have increased by 3 times, which is pretty impressive. With interest rates coming down, that's going to be another big tailwind. So we see EBIT growth of about 20%, but then as interest rates come down, interest expense will then declining, will drive EPS growth of even faster. The stock trading on 14 times 2024 PE provides a material margin of safety. So we see upside from earnings growth, but also from a re-rating, which as we think this stock should trade at a higher multiple.
It really sounds like Sendas is at a turning point, doesn't it? And actually, for any investors interested in hearing more about Brazil's cyclical and structural opportunities, you and I had a great chat last month, so please tune into that. Now, John, sticking to today's episode, what should investors avoid?
So within India, we're avoiding the consumer segment, particularly the staples companies. And there's three reasons which I'll take you through. Firstly, India as a market is trading at relative peak valuations versus all the other emerging markets. It is one of the best structural growth opportunities within EM and is attracted a lot of investor flows as a result. But India is looking expensive if you look at absolute PEs or even relative to bond yields in the country. A more accommodative environment for emerging markets will see capitals flow away from India generally. Then looking within the consumer space, which is what I'm highlighting, consumer staples in particular, these companies have re-rated from about 20 times PE in 2010 to 40 times PE average today. That's 40. This has been driven by factors that are reversing, particularly in the recent history. One of them particularly is growth scarcity in India through 2010 and 20. And that was because there was a weak capex cycle in the industrial landscape in India. And that meant basically people were willing to pay a large premium for consumer staples that had not such a high growth, but a very stable growth going forward. Now, looking forward, we're actually seeing the start of a capex cycle in India. The Modi government is putting quite a bit of emphasis on public capex growth at the moment, and we're starting to see initial signs of private capex coming back into the market. This should drive a stronger cycle, especially in the industrial side, which will then leave these consumer staple stocks that, although are more stable, are growing at a much lower rate and look relatively expensive. So we've already started to see stocks like L&T, which is the leading EPC company in India, starting to re-rate higher, and some of these staples are starting to underperform. But we think over the next year, this category in particular should underperform. Now, I know you sort of said what areas to avoid, but I do want to mention, we've got an underweight to India, but we find similar structural exposures in Mexico, particularly in that sort of staple space. And FEMSA is one of our largest positions within emerging markets, which we see having similar sort of structural growth drivers, but trading at a much lower valuation.
I really like how you turned a stock to avoid into a second stock to own. So that was nicely played, John. And finally, John, who is your guest at your Christmas lunch?
I really hate these questions because there's so many people that I'd love to have lunch with. But, it's Christmas lunch, so I'm going to go someone that's not too serious. I'm going to go for Ange Postecoglou, the head coach at Tottenham. Now, I'm not a soccer or, Premier League fan, football, I should say, fan. But my 6-year-old son has become football obsessed, which that now means that I've got to start watching a lot more football. And, seeing an Australian take on the world and, going to the Premier League, one of the greatest leagues in the world, and start to really, show great results. He's shown great resilience over the long term. And what I really like reading about the stories is how he's able to bring the passion out from the team. So I reckon he'd be a great guest to have at Christmas lunch.
He'd be fabulous. And if you're listening, you've got an invite. Thanks, John. I hope you've enjoyed this episode. We've covered a lot of ground ranging from mispriced beneficiaries of AI, cloud migration, and the energy transition, to a beneficiary of ageing demographics and retail opportunities in Latin America. From the Antipodes team, we wish you all a safe and happy holiday period. And keep up to date with us in the new year at antipodes.com or follow us on LinkedIn or Twitter.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.